Welcome to Book Bites Guru. Here, we decode the world's most powerful books on investing and wealth creation, helping you achieve financial freedom. A quick thank you to our community. If you find value in these videos, please hit subscribe, like, and follow. It truly helps us support the channel and keep bringing you these in-depth summaries. Today, we are diving deep into Charlie Munger, The Complete Investor by Tren Griffin. Charlie Munger was more than just Warren Buffett's right-hand man at Berkshire Hathaway. He was known as the Sage of Pasadena, a titan of industry revered not just for his wealth, but for his unparalleled rational thinking, keen judgment, and intellectual clarity. Munger's wisdom transcends finance. He mastered the art of decision-making itself. As he famously noted, a lot of people with high IQs are terrible investors because they have terrible temperaments. Tren Griffin's book is a structured masterclass in how Munger thinks. It connects his ideas back to the roots of value investing while expanding them with Munger's unique mental models. Let's begin with the foundation, value investing. At its core is the system developed by Benjamin Graham. It is a philosophy that is simple to understand, but difficult to execute with discipline. The system relies on three pillars. First, focus only on what you understand. If the business model is too complex to predict, pass it by. Second, don't overcomplicate your analysis. You don't need complex algorithms. You need common sense and basic arithmetic. Third, be rational and unemotional. The market is driven by fear and greed. The successful investor must be the calm anchor in the storm. This brings us to Munger's favorite concept, the circle of competence. It doesn't matter how large the circle is. What matters is that you know exactly where the edges are. Inside the circle, you have an edge. Outside of it, you are gambling. Munger avoided the tech boom of the 90s not because he thought it was bad, but because he admitted he didn't understand it. But Munger didn't just copy Graham. He evolved the strategy. Graham focused on cigar butts, cheap, dying companies with one puff left. Munger looked for quality. He famously convinced Buffett that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This shift created the Berkshire Hathaway we know today. Graham gave the rules. Munger added the mental tools to apply them effectively. He believed in a latticework of mental models to solve problems. The takeaway for this first part is clear. Great investing is simple, but it is not easy. It requires the discipline to do nothing until there is something to do. In the next video, we will break down the 4 fundamental principles of investing that act as the pillars of Munger's strategy. Make sure you're subscribed so you don't miss it. Welcome back to our deep dive into Charlie Munger's wisdom. In part 1, we established the foundation. Now, in part 2, we explore the 4 fundamental principles that guide every decision Munger makes. Principle number 1, treat a share of stock like an ownership interest in a business. This sounds obvious, but most investors forget it. You are not buying a lottery ticket or a piece of paper that wiggles around on a chart. You are buying a proportional share of a real, living business. If you understand the business, its cash flow, its customers, its competitive advantage, the daily stock price becomes irrelevant. You are an owner, not a speculator. Principle number 2, buy with a margin of safety. This is the only way to protect yourself against your own mistakes and the unpredictability of the future. Think of it like engineering. When you build a bridge, you don't build it to hold exactly the weight of the trucks. You build it to hold 3 times that weight. That buffer is your margin of safety. In investing, this means buying a stock for significantly less than its intrinsic value. If a business is worth $1, you try to buy it for 60 cents. That 40-cent gap is your safety net. Principle number 3, make Mr. Market your servant, not your master. Benjamin Graham's allegory of Mr. Market is perhaps the most useful idea in finance. Mr. Market is a manic-depressive partner. Some days he is euphoric and offers to buy your shares for a high price. Other days he is depressed and offers to sell to you for a low price. You must not let his moods influence you. You are there to take advantage of him, not to be guided by him. When he is fearful, you should be greedy. Finally, principle number 4, be rational and unemotional. Emotional decisions are the enemy of wealth. Munger relies on checklists to bypass human bias. He meticulously checks his logic, ensuring he isn't fooling himself. As he says, the first principle is that you must not fool yourself, and you are the easiest person to fool. ownership, margin of safety, Mr. Market, rationality. These are the 4 pillars. If you can master these, you are no longer gambling, you are investing. But how do you make these rational decisions? In part 3, we'll open Munger's toolbox of worldly wisdom and explore how physics, biology, and history can make you a better investor. Stay tuned. Welcome to part 3. We've covered the rules of investing. Now, we enter the mind of the master. This is about worldly wisdom, Charlie Munger's secret weapon. Most investors only study finance. Munger studies everything: physics, biology, history, psychology. He believes that if you only have a hammer, every problem looks like a nail. Investing isn't just about spreadsheets. It's a toolbox. You need a different tool for every problem. Munger calls this a latticework of mental models. You hang your experience on this latticework. You use the redundancy of biology, the tipping points of physics, and the compound interest of mathematics to see reality clearly. Take biology. In nature, systems have redundancy. If one cell fails, others take over. In investing, you need a margin of safety, a backup plan. If you optimize for efficiency alone, you die when the environment changes. Or consider physics, the concept of critical mass. A business can struggle for years, building momentum, and then hit a tipping point where it explodes upwards. If you don't understand this nonlinearity, you might sell too early. Let's look at his favorite models. First, inversion. This comes from the mathematician Jacobi. Invert, always invert. Don't just ask how to succeed, ask how to fail. Munger famously gave a speech on how to guarantee a life of misery. He didn't list secrets to happiness. He listed things like envy, resentment, and unreliability. By identifying exactly what ensures misery and failure, you can avoid it. If you know where you will die, you simply never go there. That is the power of inversion. Second, opportunity cost. Everything you do means not doing something else. If you choose stock A, you are giving up the chance to buy stock B. It applies to life too. Buying a $50,000 luxury car isn't just spending $50,000. It's costing you the $500,000 that money would have grown into over 30 years. That is the real cost. Munger doesn't compare an investment to zero. He compares it to his best alternative. If it's not better than his best current idea, he doesn't touch it. Third, avoiding confirmation bias. The human mind is wired to ignore evidence that contradicts what it already believes. This is a fatal flaw in investing. Munger cites Charles Darwin. Whenever Darwin found evidence that contradicted his theory, he wrote it down within 30 minutes. He knew his brain would otherwise reject it like a transplanted organ. Munger argues you should work harder to destroy your own best ideas than anyone else. Only if an idea survives your own brutal attack is it worth keeping. Finally, the Lollapalooza effect. This is when multiple mental models combine to drive a result that is not just additive, but exponential. Consider Coca-Cola. It isn't just sugar water. It's a Lollapalooza. You have Pavlovian conditioning from the sugar and caffeine hit. You have social proof because everyone drinks it. You have availability bias because it's in every store on Earth. When these psychological forces merge, you get a global monopoly that is almost impossible to destroy. But even with these tools, your brain can still trick you. In part 4, we will explore the psychology of human misjudgment and the specific biases that destroy portfolios. Welcome to part 4. We've built the framework. Now we must protect it. This is about the psychology of human misjudgment, the biases that sabotage even the smartest investors. Munger believes the human mind is not a logic machine. It is an evolution machine designed for survival, not for the stock market. We are filled with bugs that impair our judgment. First, overconfidence. This is the most dangerous bias. We think we know more than we do. It makes us trade too often, take too much risk, and ignore the role of luck. Studies show that the more confident an investor is, the more they trade, and the worse they perform. Munger says, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. Second, anchoring. We get stuck on the first number we see. If you bought a stock at $100, you anchor to that price. If it drops to $80, you think it's cheap just because it was $100. But the market doesn't care what you paid. The stock is only worth its future cash flows. Anchoring prevents you from seeing the new reality. You hold on to losers because you are anchored to your entry price. Third, social proof. We are hardwired to follow the herd. If everyone is buying tech stocks, our brain screams that it must be safe. But in investing, the crowd is often wrong at the extremes. Munger says you must be comfortable standing alone. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and your reasoning are right. Fourth, incentive-caused bias. Munger's superpower is understanding incentives. Show me the incentive and I will show you the outcome. Never ask a barber if you need a haircut. Wall Street is designed to sell you things. Analysts, brokers, advisors, they are incentivized to make you trade, not to make you rich. Understand their incentives before you trust their advice. Finally, consistency and commitment. Once we say something publicly, we lock into it. We refuse to change our minds, even when the facts change. This destroys flexibility. So how do we fight these biases? We can't eliminate them, but we can manage them. Munger uses checklists. He forces himself to go through the steps of rational thinking every single time. Overconfidence, anchoring, social proof, incentives, consistency. Know these traps. If you can avoid them, you are already ahead of 90% of investors. Intelligence is not enough. You need character. In Part 5, we will explore the personal attributes, patience, humility, and discipline that define the true Munger mindset. Welcome to Part 5. We have the models and we know the traps. But knowledge is useless without character. This section is about the personal attributes that separate the great from the good. Munger says, a lot of people with high IQs are terrible investors because they have terrible temperaments. You need to keep your head when everyone else is losing theirs. First, patience. The big money is not in the buying and selling, but in the waiting. Munger sits on his hands for years, doing absolutely nothing, until the perfect opportunity arrives. He uses the baseball analogy. You don't have to swing at everything. You can wait for the fat pitch. In investing, there are no called strikes. You can stand there all day until you get the one you want. Munger jokes that his success comes from lethargy bordering on sloth. Most people feel the need to do something. The great investor knows that doing nothing is often the smartest move. Second, discipline. It's easy to be rational when things are going well. It's hard when the market crashes 50%. Discipline is sticking to your checklist when your emotions are screaming at you to run. Munger says, if you can't stomach a 50% decline in your paper wealth, you are not fit to be a common shareholder. You must have the discipline to see opportunity where others see panic. You must have the discipline to ignore the noise. As Munger says, it takes character to sit there with all that cash and do nothing. I didn't get to where I am by going after mediocre opportunities. Third, humility. Acknowledging what you don't know is the dawning of wisdom. Munger destroys his own ideas because he knows he can be wrong. He is never afraid to say, I don't know. This humility drives the fourth attribute, continuous learning. Munger and Buffett are learning machines. They read hundreds of pages every single day. Spend each day trying to be a little wiser than you were when you woke up. If you do this for a lifetime, the compound interest of knowledge becomes unstoppable. Think of it like a sequoia tree. It doesn't grow tall in a day. It grows a little bit every year for thousands of years. Eventually, it towers over everything else. That is the Munger strategy. Patience, discipline, humility, learning. These are not just investing tactics. They are a way of life. They are the engine that powers the mental models. We have covered the man, the principles, the models, the biases, and the character. In the final video, Part 6, we will bring it all together and apply these ideas to build your own path to wealth. Welcome to the finale. We have explored the principles, the models, the biases, and the character of Charlie Munger. Now, we bring it all together. How do you apply this wisdom to build wealth and a better life? First, in investing, stop looking at the ticker tape. Start looking at the business. Ask yourself, do I understand this? Is there a margin of safety? Is the management rational? Build your checklist. Before you buy, force yourself to write down the reasons why you might be wrong. Use inversion. If you can't state the opposition's case better than they can, you have no right to have an opinion. Second, in life, Munger's wisdom isn't just about money. It's about thinking better. Be curious. Read constantly. Know your circle of competence and stay strictly inside it. Remember, you don't have to be brilliant. You just have to avoid being stupid. Avoid the standard traps: envy, resentment, self-pity, and denial. These are the mind killers. Let's recap the Munger system one last time. The 4 principles: treat stocks as ownership. Buy with a margin of safety. Use Mr. Market's moods. Be rational. The mental models: build a latticework of ideas from physics, biology, and history. Use inversion to solve problems backwards. Understand opportunity cost and the power of incentives. And finally, character. Cultivate patience to wait for the fat pitch, discipline to hold through the crash, and humility to keep learning every single day. As Tren Griffin writes, it is simple, but not easy. It requires a lifetime of discipline, but the reward is not just wealth. It is a life of clarity, independence, and wisdom. We leave you with Charlie's words. The best thing a human being can do is to help another human being know more. We hope this series has helped you know more. This was just a summary. To truly master these ideas, we highly recommend reading Tren Griffin's book, Charlie Munger, The Complete Investor. If you enjoyed this deep dive, please support Book Bites Guru. Like, subscribe, and hit the notification bell. Let us know in the comments which book we should break down next. Thanks for watching.